There's always somebody who's screaming that the stock market is going to crash, and you're always going to have somebody who's yelling that the stock market is about to rally. But what you need to understand is that bulls make money, bears make money, but pigs get slaughtered. In the Wall Street language, bulls are people who think the market is going to go up. Bears are people who think the market is going to go down, and pigs are people who get greedy. So who makes money? People who think the market's going to go up, people who think the market's going to go down, but the people who lose money are the people that get greedy. You can make money when the market's going up, you can make money when the market's going down, but if you're getting greedy, well, you're the one that's making both of these people, the bulls and the bears, rich. The stock market almost acts like a double-edged sword because the reasons why the stock market is so great is the same reason why the stock market causes so many people to lose money. The reason why the stock market can be a great wealth-building tool for so many people is because it's liquid, it's easy to access, and it's easy to value. When you invest your money in the stock market, you can sell your stocks whenever you want when the market is open. It's easy to value because you can go onto any stock market brokerage, website, app, or research company and you can see exactly how much Amazon or Tesla is trading for. And it's super easy to use because you can start investing in stocks with as little as $1. But those same reasons are the reasons why people lose so much money in the stock market. It's liquid, so it's easy to sell when you get scared. It's easy to value, so you can easily get greedy. You can easily start panicking when you see a market down. And so that's when you can sell quickly, and because it's so easy to access, anybody can start throwing their money into the market without any sort of financial education. And if you leverage up your bets because your brokerage tells you or some random person on the internet tells you that you should go into debt to trade stocks because now you can 10x your returns, well now, yeah, you can make more money when things go up. But when things go down, you lose even more money. There's an infinite amount of strategies out there on how to make money in the stock market. Everybody has a different strategy, everybody has a different formula, and there are so many different ways that have been proven to show how to make the most money in the stock market. But the reality is, for the vast majority of people, if you just want to build sustainable wealth in the stock market, you should not be following these complex, these crazy strategies that have these expensive fees. There are simple solutions that you can do that bypass all the complexity, that bypass all the time invested, and that bypass all the fees that allow you to build sustainable wealth over the long term. Take a look at this chart right here. This is a 100-year chart of the Dow Jones Industrial Average. This is a 100-year chart of essentially the stock market. And what you see is that you have booms, you have busts, you have recessions, you have crashes, you have ups and you have downs. But over the long term, what do you see happen? The stock market has risen over the last 100 years. See, what most people are trying to do is they're trying to time the top, they're trying to time the bottom, they're trying to find the perfect company, they're trying to do all this research which works for maybe 5% of investors. But for the other 95% of people, you don't need to be spending all that time, effort, money, research trying to understand how to make the best returns. For 95% of people who don't want to be active investors, who don't want to be actively looking for the best companies, who don't want to be actively listening to earnings calls, who don't want to actively be reading cash flow statements, balance sheets, and income statements, if you don't care about doing that, if you just want to make money in the stock market and not have to think about it, then there's a simple strategy that you can follow. And this doesn't mean that you have to go and find the next hot stock. You don't need to go and find the next Tesla before it booms. You don't have to go and find the next Amazon. You don't have to go and try to pick the best company. You can just invest your money in the stock market and let the stock market do its thing. Because if we go back to the chart, just take a look at the chart. Over 100 years, what do you see? Well, the stock market has gone up. Yes, you have booms, you have busts, you have times where the market goes up and you have the market goes down. But if you just invest your money into the market and you let the market do its thing, it has been proven over the last 100 years that the market goes up over time. Why? Because if you believe in the American economy, if you think the American economy will continue to grow, that the American economy will be stronger 10 years from now, 20 years from now, 30 years from now than it is today, then the stock market should also follow that same pattern. Yeah, maybe you're going to see some different booms and busts, but over the long term, if you zoom out, what you'll see is as long as the economy keeps growing, the stock market will continue growing as well. I'm going to show you exactly how to follow through with the strategy in just a second, but the nice thing about this strategy is it doesn't matter if you're entering a recession, or if you're in a recession, or if you're in a boom. The strategy doesn't change because this is a long-term strategy. If anything, the only thing that you would do is if you go through a market crash, or if you go through a recession, the only thing that you would do is buy more. You don't change your strategy. With a long-term investing strategy like this, You just let the money work on autopilot, and the only thing that you would do is if you see a market crash, you just buy more. This is a long-term strategy to build wealth over the long term, and by long term, I mean 20, 30, 40 years. I'm not talking about 2 years. I'm talking about a long-term strategy where you invest your money into the stock market to own a piece of the economy. That way, as the economy and the country grows over the course of your life, well, your wealth grows as well, and you don't have to spend hours of your time. You don't have to pay these excessive fees. You can just let your money run on autopilot and just watch your wealth grow year after year after year. Does that mean that it's going to go up every year? No. You're going to see crashes, you're going to see busts, you're going to see recessions. That's a part of the economy. But when everybody's freaking out, when everyone's talking about the world ending, when everybody says we're going to enter World War III, when everybody says the stock market's going to crash, we just let your strategy do its thing. Because this isn't new. This happens every 10 to 15 years. You see booms, you see busts. We've seen a recession pretty much every 10 to 12 years for a century now. So you can expect that to continue to happen. And every time that happens, everybody says capitalism is ending. Our economic system is coming down. We're going to enter another war. All these things have happened in the past. All these stories have come out before. But if you just turn off the noise, follow the strategy, what we've seen happen over the last 100 years is it works. The name of the strategy is DCA, which stands for dollar cost averaging. And the whole idea here is you are going to invest your money periodically into the market, and you can automatically set this up where every week, every 2 weeks, or at least every month. I personally do, and I like every week, but you can find the best strategy for you, where now every so often, you're going to consistently, passively, and automatically invest your money into a fund that gives you broad exposure to the market. Now, I do got to give you a little bit of a disclaimer right now, because investing does have risks. You are never guaranteed to make money when you invest. You might even lose money, so always talk to a professional before you make an investment decision, and never blindly trust a random guy on YouTube. All the funds that I talk about are just for examples. I'm not telling you what to invest in. So talk to a professional if you have specific questions about your own financial statement. Now the question is, where do you actually invest your money? How do you actually get exposure to the market? Because there's no direct way for you to just invest your money in the stock market. You have to invest your money into something, some investment tool that gives you exposure to something called an index of the stock market. So a fund is, you can think of it like a group of stocks. Because if you go and invest in Amazon or Tesla or McDonald's or Coca-Cola, what you're doing is you're investing in one company. And you're hoping that this company is going to succeed. And you can make a lot of money doing this. But again, now you're putting a lot of your investment risks into one company, because if that company were to go down, if Amazon went bankrupt, well, now your investment goes to zero. And this is where understanding, are you willing to put in that risk and time and energy and research to invest in the company? Or do you want to just invest in a fund that gives you exposure to maybe 100 companies? And maybe Amazon is in this fund. So if Amazon were to go bankrupt, well, the fund would just kick out Amazon and put another company in there. So when you invest in a fund, you get much less risk. And yeah, you lose some of the upside, but you also lose some of the downside. And so for the average investor, somebody who doesn't want to pay attention to all the earnings calls, somebody who doesn't want to read all the financial statements, this is a much simpler way for you to invest. The next thing that you have to decide is what index, meaning what category of things that you want to invest in. Like the Dow Jones is an index. The Dow Jones is an index of 30 companies. Then you have the S&P 500. That's an index of the 500 biggest companies on the stock market. Then you have something like the NASDAQ. The NASDAQ is an index of 100 companies, the largest companies that are not financial. And so you can decide what kind of index do you want to invest in. Do you want to invest in the Dow, the NASDAQ? Do you want to invest in the S&P 500? Do you want to invest in the broad stock market and all the companies? Do you want to invest in tech? Do you want to invest in healthcare? So you can start to think about what kind of index that you want to invest in. Once you start thinking of what kind of things you want to invest in, now you can find the right tool to actually invest in this asset class. And there's a couple big ways for you to do this. One is through an ETF, which stands for an exchange traded fund, and the other is an index fund. These both give you exposure to these types of indexes like the Dow Jones, the S&P 500, or the broad stock market, or even specific sectors like healthcare or tech or whatever, but they give you different types of exposure. Like I like ETFs personally just because ETFs work just like stocks. You can buy and trade an ETF at any time with most brokerages, and you can sell an ETF as many times as you want. And most ETFs don't have any sort of minimum investment requirement. You can just buy whatever amounts of this ETF that you want. You can compare that to an index fund, which gives you exposure to the indexes that I just talked about. But unlike an ETF, most index funds, you can only buy or sell once in a day. And many index funds also have a minimum investment. It might say that you have to invest at least $500 or at least $1,500 in order to get exposure to the index fund. So you have more restrictions with an index fund, but they work very similarly to ETFs. It really doesn't matter which one you use. Some people love index funds. I personally just like ETFs. Here's a few examples of how it works. And again, I'm not telling you what to invest in, just giving you some examples. So the S&P 500 is an index of the biggest 500 companies in the stock market, and a couple popular ETFs that give you exposure to the S&P 500 are SPY or VOO. I personally have some of my own money invested in VOO as a disclaimer. So now, when you invest your money into SPY or VOO, you're getting exposure to the 500 biggest companies in the stock market. They trade just like stocks. These are ETFs, and it's a simple way for you to get exposure to the entire index. For the NASDAQ, which is an index of 100 of the largest non-financial companies, many of these have been tech companies over the last decade, but for the NASDAQ, one of the most popular ETFs that gives you exposure to these companies is QQQ. This is an ETF created by Invesco. Invesco is the institution that manages and creates this investment fund. This is created by Vanguard. This one's created by Spider. All these are different institutions that create these types of investment funds. For the Dow Jones, which is that group of 30 companies, the most popular fund is DIA. And then if you just want total exposure to the stock market, you want broad total stock market exposure, you could look at an ETF like VTI. This one is by Vanguard. Once you know what kind of funds you want to invest in, the next thing is creating a system so your money is automatically invested into these funds. That way it can be consistent, passive, and automatic. And the best way to do that is to find a brokerage that specializes in this type of passive investing. When I say passive investing, I mean where your money is automatically pulled out of your account and invested into your portfolio of funds. And so there's a number of brokerages that do this now. You can look for one yourself. I use a platform called M1 Finance. They are an affiliate of mine. I'm not telling you what to use. Do your own research. But if you want to learn more about them, I put my affiliate link down in the description below so you can see some of the other platforms that I use. But again, there's a ton of them out there. Find the one that's best for you and always do your own due diligence. So what you want to do now is create a system where anytime you get paid, you have money that's automatically pulled out of your account and invested into your portfolio of funds, and then you don't touch it. This is the key. This is the key if you want to succeed with this. You don't touch it when things go wrong. You don't touch it when things are crashing in the markets. When I say things go wrong, I mean like you see the economy slowing down or when you see the markets are going down. Because if you start to see these types of things happen, now, the money that you invest will allow you to buy more shares of these funds. If something really goes wrong with Vanguard or with Spider or with Invesco or one of your investment institutions, then that's a different story. But this is where your job is not to be paying attention to the markets every single day. This is where your job is not to be stressing out about earnings calls and to be paying attention to every single company. This is where you've created a passive system. And now your money is being invested. You do this every week, every 2 weeks, every month. It's completely passive, it's consistent, and it's automatic. And you don't touch it, and you're going to let this happen for years. You're going to let this happen for decades, and let your money give you exposure to the markets and let it grow and compound over time. I do a mix of things. I have my passive investing strategy like I just talked about, but I also have an active strategy because I like researching companies. I like taking on some of the extra risk. I enjoy keeping up with the markets. So while I have my passive strategy going on, I also have cash for my active strategy. And you got to find what's right for you. Maybe you'll do a hybrid. Maybe you only do passive. Maybe you only do active. You got to find what's the right strategy for you. But at the end of the day, this is where it pays to be financially educated. That way you don't just blow your money on things that don't matter to you, and you don't get greedy, you don't start panicking, you don't go through all the emotions of stock market investing, because the things that make the stock market so great are the same reasons why investing in the stock market is so difficult, because you can get very emotional. And this can be great when things are going up, but it's 10 times more painful when things are going down. And this is where you want to be financially educated. Now, we do have a free ebook on investing your money, how you can start generating passive income, even if you don't have a ton of money to start. If you want to read this ebook, it goes a little bit deeper into investing. That way you can learn the different ways that you can invest your money. You can learn about different ways that you can start generating passive income. If you want to read this ebook, it's completely free. and I'll put the link to how you can download this ebook down in the description below. When I invest my money, there's two things that I always look for. I look at how much risk is involved, and I look at how much money I can potentially make. If I was gonna invest $10,000 and I had to decide between investing this $10,000 into my broke cousin Bunty, who's on his 34th business idea, or investing this money into Amazon, who's established and has a business plan and is very successful, I'm gonna expect very different returns to justify my investment. Bunty is a risky investment, so I'm gonna need bigger potential returns to justify me giving him my cash, because as soon as I give him that $10,000, there's a good chance that he's gonna invest that money into a new Gucci wardrobe. I gotta look good for the business. Deciding between investing your money in my cousin Bunty or Amazon is pretty obvious. I'm gonna invest my money in Bunty. But what if you had to decide between investing your money between Amazon and Apple and FedEx and Verizon and McDonald's and Microsoft? Who's gonna give you the best return for your risk now? Not so easy anymore. There's three different ways that you can take this. Option one is you can spend all the time researching these companies, and you might decide that Apple is the best company to invest in based off of all your research, and now you invest all your money into Apple. This one has the most risk because now if Apple releases a really bad iPhone and people start hating Apple products and their company tanks, well, down with it goes your money. It also comes with the most upside because now if you're right and Amazon wins big, then you're gonna win big. Option two is now you can open up a stock brokerage, and instead of just investing in one company like Apple, you can invest in every one of these companies. That way you're lowering your risk. If you do want to learn more about how to actually open up a stock brokerage and invest your money in stocks, our team wrote an article on our website, theminoritymindset.com, that walks you through how to do that. So if you want to read that article, I'll link it for you in the description below. This one requires more work because now you're not just managing and monitoring one stock, you got to manage and monitor a whole portfolio of your stocks. Or option three is you can pay a small fee and then you can invest in a fund like a mutual fund or an index fund or an ETF, and let these funds invest in all these companies for you. So now instead of you going out and investing in all these companies, you invest in a fund that gives you exposure to all these companies. While all three of these funds give you exposure to the stock market, they work in very different ways which can affect how much money you make, which is why you want to understand the differences. And that's what I'm going to be going over in this video as soon as you fund that thumbs up button below. Let's start with mutual funds. Mutual funds are known as actively managed funds. And to understand how they work, let's assume for the sake of this example that this is a mutual fund that's made up of only 4 stocks. A lot of times mutual funds will have way more stocks, sometimes hundreds of stocks, but just to keep things simple, we're going to assume that this mutual fund only has 4 stocks. If you wanted to invest in McDonald's, Tesla, Apple, and Amazon, one thing that you could do is you could go out, open a stock brokerage, and individually invest in McDonald's, Tesla, Apple, and Amazon. But now you have to decide how much of your money are you going to allocate towards each stock and what stocks do you want to own. On the flip side, when you invest in a mutual fund, you have this person right here. We're going to call this person a money manager, and we're going to draw him a nice mustache. This money manager is who you're trusting. So you're going to give your money to this money manager, and this money manager is going to create this fund. So this person is managing this fund, and when this money manager likes a stock, they're going to buy it. When they don't like a stock, they will sell it. So maybe right now this money manager likes these 4 stocks, but some time goes by and he's like, you know what? I don't like McDonald's anymore. We're going to replace them with Chipotle. So now he's monitoring the stocks and he's actively buying and selling based off of what he thinks is going on in the market and based off of what he thinks is going to make this fund more money. The whole point of a mutual fund is to have a really smart money manager with the goal of this money manager being able to beat the general stock market. So you are hoping that by paying this money manager a fee, you are going to be able to outperform the stock market, which in turn will make you more money. You're also getting the benefit of passiveness because now you're not having to go out and individually invest in all of these companies and manage each one of these companies. You have a money manager who's going to do that, and you also have the benefit of diversity because now this money manager is diversifying your money into different companies. If you want to invest your money into a mutual fund like this, you can expect this to cost you something like 2% a year on all of your assets. What that means is if you deposit $100 into your mutual fund, this money manager is going to take $2 a year to manage your $100. So if you invest $1,000, that's $20 in fees. And if you invest $100,000, that's $2,000 a year in fees. Now, while 2% might not sound like a lot of money, it does add up, especially as your money grows and compounds. Like if you started investing $500 a month today and you were paying 2% a year in fees and you were able to get an average 7% return on your money, over the next 30 years, you're going to end up paying something like $166,000 in fees to your money manager just to invest your money. Now, look, I'm a value person. If you can make me an extra $1,000, I will gladly pay you an extra 2% in fees. So if you can make me more money, I will pay you more money as long as I continue to come on top. The only issue with this is what we've seen over the long term is these mutual funds don't always outperform the market. Actually, a lot of mutual funds can't even meet the returns of the general stock market over the long term. Like Warren Buffett was so confident in this that he made a $1 million bet that the general stock market, the S&P 500, would be able to outperform a number of hedge funds. These are highly sophisticated, highly expensive hedge funds. And over a course of 10 years, the hedge funds did well, but they did not even meet the stock market returns. So then the hedge fund owner had to then pay Warren Buffett $1 million because he lost the bet, and Warren Buffett took that $1 million and he donated it to charity. I'm gonna go over how you can get the general returns of the stock market without paying these high fees, but in general, a mutual fund's goal is to be able to beat the market. That's why you're paying these fees to a money manager. That way you have somebody who can hopefully beat the market. The only problem with that is a lot of times you will not beat the market. Sometimes you will, sometimes you won't. It's really hard to predict because it's hard to beat the market, especially over the long term. This is not to say that mutual funds are never the right answer. I mean, there are some really good mutual funds out there, but a lot of these really good mutual funds are reserved for super high net worth people. Like you need at least $500,000 to get into some of these mutual funds versus some of the regular mutual funds that you're just paying 2% on. You could get a better return without paying all the fees. Second, let's talk about index funds. So the whole idea of index funds came about by this company called Vanguard, and Vanguard said, you know, what if we could let people invest in a group of funds like this without paying these super high fees? Well, the only issue with that is you need to pay this money to a money manager. So if Vanguard wanted to create this index fund where you can invest in a fund without paying all these fees, they also had to get rid of this person with a mustache right here. And instead what they did was they replaced that person with a mustache with a computer who automates this investments. Now you're investing in a fund, a group of companies, but instead of having a money manager decide which companies are in this fund, you're going to have a computer decide. So you create an algorithm. What are the type of companies you want to invest in? You punch that into the computer, and then the computer decides what company fits that fund. For example, I just talked about investing in a fund that gives you exposure to the S&P 500. The S&P 500 is an index, meaning it's a group of stocks that gives you exposure to the top 500 companies in the stock market. Now, one thing you can do is go out and individually invest in all 500 of these companies, but that's going to take a lot of work and a lot of management headache. Or you can invest in an index fund that gives you exposure to all 500 of these companies. That's what Vanguard allowed you to do. Now you can just invest in this index fund, and that gives you exposure to these top 500 companies. So now you're getting exposure to the general stock market without paying all the fees. VFIAX is the Vanguard index fund that gives you exposure to the general stock market. So Vanguard is the company that created this index fund. There's a bunch of banks and a bunch of companies that create these type of things. Vanguard is just one of those companies. It was the first to create index fund. So Vanguard has this index fund, which is a group of stocks that gives you exposure to the top 500 companies. If you want to know how much fees these index funds cost, all you got to do is search it on Google. So like with this VFIAX, you can see it says in the title that this is the Vanguard 500 Index Fund Admiral Shares. It has the word index fund in the title, so you know it's an index fund. And over here, you can see something called the expense ratio. This expense ratio is how much money you're going to be paying in fees. That's what you want to pay attention to. 0.04% in fees means that for every $100 you invest, you're going to be paying 4 pennies in fees. Compare that to the 2% fee you'd have to pay with a mutual fund where you're paying $2 out of every $100 you invest. So the fees with an index fund are way less because now you substituted that money manager with a computer, and computers are a lot cheaper to maintain than people, especially if they have a mustache. What you have to understand about index funds is a lot of them have a minimum investment. Like this Vanguard index fund has a minimum investment of $3,000. So if you don't have $3,000 to invest, you cannot invest in this index fund, and you also can't just buy and sell this index fund whenever you like. Index funds like VFIAX only let you buy and sell this index once a day. So if you're trying to trade index funds and mutual funds, that's not the way to go because you can't just buy and sell an index fund whenever you want. You can only do that one time in the day, and typically it happens at 4 p.m. as soon as the market closes. But if you're looking to be a long-term investor, it really shouldn't matter too much because now you're looking to invest for the long term. You're not looking to invest for 2 hours. And so what happens now is you're not going to see people trading these index funds every single day because you just can't do that. The alternative to investing in an index fund like this is investing into an ETF. ETF, which stands for an exchange traded fund, because ETFs that you buy and sell these funds kind of like stocks. You can buy and sell these ETFs whenever you want, and some index funds have ETF versions of them too. Like if we go back to the Vanguard website, you'll see that this index fund also has an ETF version. It says it right below the title. Also available in an ETF. If you click that button, it will take you to the ETF version of this index fund, which is VOO. VOO is an ETF that gives you exposure to the S&P 500, so the top 500 companies in the stock market, and this has an expense ratio of 0.03%. You can find this the same way you find the expense ratio of an index fund. Just search it on Google, and on this website, it will tell you what its expense ratio is. That's how much money you have to pay in fees every single year. So here, if you invest $100, you're going to be paying 3 cents a year in fees, so almost nothing. But unlike an index fund, you can buy and sell shares of VOO every single day whenever you want when the market is open. Remember, with the Vanguard Index Fund, you had a $3,000 minimum investment, and those transactions only happen once a day. With VOO, you don't have a minimum investment. All you have to do is buy 1 share of this ticker symbol, and then you can buy or sell VOO whenever you want throughout the day. So between this Vanguard ETF that gives you exposure to the S&P 500 and the Vanguard Index Fund that gives you exposure to the S&P 500, they both charge you essentially the same fees. They both invest in the same companies. The difference is VOO, you can see the real-time price throughout the day, versus the index fund you cannot. VOO does not have a minimum amount of money you have to invest, versus the index fund you do. However, the index fund allows you to automatically invest or withdraw your money, versus this ETF does not. So if you invest your money through Vanguard, you can automatically reinvest more money every single month through Vanguard, versus with this ETF, you cannot do that. So if you're looking for a passive way to invest your money, that index fund gives you the benefit, because now your money can automatically be invested every single month without you having to do anything, versus you can't do that with an ETF unless you're using a brokerage that can passively invest your money for you. The whole reason for you to invest your money into these passive investments is to see your money passively grow and compound over time. But if you want to see your money really compound quickly, you got to keep adding money to your investments. And the simplest way to do that is every single month, just add more money into this fund. So if you invest your money into the index fund, that can automatically happen. You can't do that with this unless you use a brokerage that automatically pulls money out of your savings account or your checking account, and they invest this money into your fund. If you want to learn more about how to do that, our team put together an article that breaks down the basics of investing, and I'll link it for you in the description below. So ETFs work almost the exact same way that stocks do, because you can buy or sell shares of an ETF the same way you do a stock. You can see the real-time price of an ETF the same way you can do a stock, and you don't have a minimum investment you have to invest minus the share price the same way you do a stock. Index funds, on the other hand, can give you exposure to all the same companies, and they let you do the automatic investing too. When it comes to your money actually being invested in an ETF or an index fund, there's an algorithm that tells the computer which company should be in your fund. So if you're investing in this ETF or in this index fund that gives you exposure to the top 500 companies, now what this algorithm is going to look at is which companies are in the S&P 500. If one of the companies in here, so let's assume Tesla for the sake of this example, tanks, and Tesla stops making money and their market cap decreases, then what this index fund will do is say, okay, Tesla is no longer in the S&P 500. They're no longer one of the top 500 companies or the biggest 500 companies. So they're going to kick Tesla out, and they're going to put in whatever the new company is that replaces Tesla. So it happens passively. You don't have to do anything. This happens in your index fund for you. And because this is happening through an algorithm, through a computer, you get to pay way less fees. So between mutual funds, index funds, and ETFs, which one can make you the most money? Well, before I say that, let me just remind you that investing has risks. You are never guaranteed to make money when you invest. You might even lose money. So make sure you always do your own due diligence and never blindly listen to a random guy on YouTube. In general, for the majority of people, I mean, there's always going to be outliers and exceptions to the rule, but for the majority of people in general, index funds and ETFs are going to be the better way to go, because now you're going to meet the stock market returns and you don't have to pay the super high fees. Now, obviously, there are some mutual funds that are going to do great. There are some mutual funds that are going to greatly outperform the market, but there's a chance that you might not get that mutual fund. There's a chance you're going to pay the high mutual fund fees without even getting the market returns. So if you believe in the American economy, then you're going to believe in the American stock market, which means over the long run, the stock market will continue to go up. And if that's the case, then you can just get the consistent returns of the stock market by investing your money in the general stock market, by investing in an ETF or an index fund that gives you exposure to the general stock market. Between an ETF and an index fund, this is really personal preference. I mean, do you want to have the automatic reinvestment into an index fund, or do you want to just invest invest your money into a brokerage that can automatically invest your money for you. Personally, I like ETFs because I like the freedom that comes with them. The key to succeeding with any of these is really just consistently investing your money month after month after month and keeping your money in the market for long enough. History has showed us that the stock market and the economy always goes up. That doesn't mean it'll always go straight up. Sometimes it will come down, sometimes it will crash, and sometimes it will correct. But over the long run, it will continue to go up as long as the economy keeps growing. So if you believe in the American economy, then this is a way for you to get that upside without actually starting your own company. So for me, food is a reward, and I like to do all the lighter things, the things that don't require as much physical effort or as much stress. I put that later in the day, that way I can do it after I eat, because after I eat, typically I'm gonna feel a little bit more tired. Second, this one's a recent hack that I started doing, is I don't check my phone until I'm close to being ready. So what I used to do was I would wake